Welcome to the Deep Dive. We're here to cut through the noise, find those aha moments in complex topics without the usual information overload.
That's the goal.
And today, we're looking at natural gas, specifically through the lens of fund manager Josh Young and his Bison Insights.
Right. Bison Insights is basically Josh sharing his highest conviction ideas, the ones with real upside potential, he thinks.
And right now, that focus is squarely on natural gas.
Exactly. He sees some, let's say, unique opportunities there at the moment.
Yeah, so let's talk about gas. The standard view, the consensus is pretty well established, isn't it?
Oh, yeah. Everyone's talking about structural demand increases.
Driven by, AI data centers needing massive power, and also all these new U.S. LNG export terminals coming online.
Precisely. Those are the big drivers everyone points to for a long-term bull case.
And look, that view has already pushed up stock prices for a lot of the mid to large gas producers.
Which, of course, means maybe the easy money's been made there, potentially less upside, maybe a bit more risk now.
So this is where Josh Young's view differs, his variant view, as you called it.
Yes. And it's interesting. He absolutely agrees that AI and LNG are huge factors. Can't deny that.
Oh, wait.
But he believes the market is really underestimating how quickly these new LNG facilities are actually ramping up, like right now.
Faster than expected. You have examples.
Definitely. He points to Plaquemines Phase 2. It's already producing LNG.
Yeah.
And Golden Pass Train 1, it's already taking feed gas.
Okay. And how does that compare to, say, official estimates?
Well, the EIA had Plaquemines Phase 2 pegged for October 2025 and Golden Pass for May 2026. So they're way ahead.
Wow. Okay. That is a significant difference. Months, even close to a year ahead in one case.
It's a big deal for the supply-demand balance, potentially hitting sooner than folks think.
And I think you mentioned earlier, there's more to it. He's identified something else the market is missing.
That's right. There's a third factor, kind of overlooked, he argues.
Look at one.
It's about how the gas is produced, specifically the role of associated gas. That's the gas that comes up when you're drilling for oil.
So companies primarily focused on oil might actually be producing a lot of gas on the side.
Exactly. And the market often puts these companies in the oil box and doesn't fully value that gas production, especially compared to the pure play gas producers.
Interesting. So it's a classification issue almost, leading to mispricing.
Sort of, yeah. This insight, this focus on associated gas and the timing, it's led him to find some specific companies he thinks are, well, very cheap. Mispriced gas equities.
Because people aren't looking in the right places or aren't valuing the gas correctly if it's coming from an oil company.
That's the idea. You're looking for gas, but maybe you should be looking at certain oil producers too.
Can you give us a flavor of these companies, without naming names, of course?
Sure. One example is a company that gets labeled an oil producer. More than half its energy output is oil.
Okay.
But because it produces so much associated gas, if you look at it on a per dollar invested basis, you actually get more natural gas exposure than from some dedicated gas companies.
Huh. Like a hidden gas play inside an oil stock?
Pretty much. And then there's another type of company that is mainly gas focused.
Right.
But it's got maybe high institutional ownership, yet surprisingly low trading volume. It just doesn't get much attention.
So it flies under the radar. A classic value situation.
Exactly. Overlooked, maybe misunderstood, not flashy enough for the big indexes or analyst reports, perhaps. So potentially undervalued.
It really highlights how looking beyond the consensus, beyond the obvious labels, can uncover value.
It absolutely does. That's where the real edge can be found, digging into those details.
So Josh has put together a full analysis on this.
Yes, the complete thesis, including the specific companies he's identified and why he sees significant upside, that's all available for premium subscribers who want to dive even further.
Okay, so for you listening, the key takeaway here is maybe the importance of questioning that consensus view. Look at the timelines. Look at how companies produce, not just what they produce.
Right, because sometimes the best opportunities aren't the most obvious ones.
That hidden value might just be waiting for those willing to take a deeper dive.